because this property's potential, let's say, is to make $1 million a year, and it's only making $500,000 a year now. I can buy that on a 7 cap because I know even if I sell it in an 8 cap and double the revenue, I'm killing it. How's it going, guys? Welcome back to How to Invest in Commercial Real Estate.
What's up?
Welcome back.
Yeah, what's up? We've talked a ton about evaluating deals and cap rates and how you should look at them. And today we just wanted to give a full disclosure or warning about what cap rates don't include and maybe some things you need to look out for when you're evaluating deals on a cap rate, because there's a lot of things that cap rate doesn't include. And if you're not asking the right questions, you may get caught.
Yeah, it's a good general guide to give you a baseline for a property's value, and it can indicate a predicted first-year return if you paid all cash for the property. But there's not just the return from cash flow isn't the only return that you get from real estate. There's a lot of other things going on, and today we want to kind of dive into what the cap rate's missing, and we'll mention another tool that we use. It's our preferred tool to evaluating the returns.
Yeah, so I would say, for just generally speaking, a cap rate is used to measure the cash flow from that property, or mainly the cash flow from the profit and loss. So the profit from the property. But there's other things that's not on the P&L, maybe on the balance sheet, that's being capitalized, that's not going to be included in that cap rate. And you could get stuck with that, right?
Yeah. Brian, what's the first big thing that the cap rate doesn't take into account?
Well, I'd say it doesn't account for the debt that you have on the property, on the asset, right?
Yeah, it's
probably the biggest one.
It's purely NOI that over divided by the purchase price.
Right.
That's all it's taken into account.
Yeah.
So then you've got to take into account debt.
Yeah.
So people think of debt as positive leverage, and that's where you're getting a higher cap rate and a lower interest rate on your debt, and you're making a yield on that money, and it juices the returns. But is there a situation where you could be in a negative leverage situation?
Absolutely.
Where you're paying more, or you're paying more on your debt than the cash flow on the property, right?
Yeah, you're paying more for the debt than the property is paying you in cash flow.
Yeah,
right. So you just end up upside down.
Yeah.
And how that would happen is if you bought on some stupid low cap rate deal, the property's not cash flowing, but the debt is still there every single month.
Well, is it necessarily a bad thing? I mean, in the first year or two, I mean, are there situations where maybe that's not a bad thing? Maybe you've got a property that you expect to appraise or increase in value a lot, or is it always a bad thing? If
you're underwriting it, it's not a bad thing if you're expecting it, I would say. Yeah. But a negative leverage situation, just to define negative leverage, it's that when you have the debt payment on the property is more than the net operating income it produces. So you're upside down month over month.
Yeah.
Yeah, you could run into that with, let's say you bought a 6 cap deal and your interest rate is 4.5 on a 25 or 30 year AM. That would produce a negative leverage situation. Now, the interest rate is still lower, and so you're still essentially making money, but any profit that you're making is going to pay down that debt. It's the principal portion of that payment, but your debt payment as a nature of cash flow is going to be higher than that NOI.
So let's talk about why somebody would do that.
Yeah, we've done it. You take a really skinny cash flow deal because the property was 60% occupied at the time you purchased it, and there's real upside in bringing the occupancy up.
Well, Tamarac's a good example of that.
Yeah, Tamarack was a apartment property that Precision bought. It was 30 or 40% occupied, and we had a hard time even getting a loan because it didn't cash flow.
You didn't get a loan. You paid for it in cash, didn't you?
No, we got a small, we got like a 50% loan, LTV, loan to value on that, because it wasn't cash flowing when we bought it. But we showed the lender, hey, we're getting it at a low purchase price. It's worth the negative leverage, the negative cash flow from the debt, in order to give us time to fix it up and to get it rented. And of course, it's been a really good asset for us. So there are reasons why people might take on a negative leverage property.
Okay. Going back to it, that apartment complex and kind of the capital expenses that might not be included in a net operating income. When you're buying an apartment complex, the remodel or the make ready typically isn't always included on your P&L. They may be capitalizing appliances or carpet or flooring or some drywall or some big capital expenses in that apartment complex. And so you're already in a negative leverage situation because your debt is costing you more money than the property is producing. And then now you're having to go into that same apartment complex and take additional dollars that the property isn't producing and inject it back into the property to try to get it to make more money, right? So you're not in a negative leverage situation, but that costs even more money.
Yeah, and it can even happen on a higher cap rate deal. A lot of times people will see a high cap rate deal and they'll think, this is great, I'm getting an 8 cap, a 9 cap. But typically higher cap rate deals, not only maybe in a tougher area, but it may be because they have an old roof, the parking lot is torn up, the overall condition of the property is run down. So you're getting it at a higher cap, but you're immediately going to have to spend more money in order to stabilize that asset, and that will bring your returns down. So you got to know that capital expenditures are not included in that cap rate.
Yeah, it doesn't include deferred maintenance, right? So you may have gotten that at a 10 cap, but you're going to have, $500,000, $600,000, $700,000 maybe that first year in repairs, and you need to make sure you're underwriting that. So I think the biggest theme of that is you can't just rely on the net operating income. You've actually got to know the deferred maintenance. You've got to inspect it. We talked about that in underwriting. You go in and you hire somebody that does the physical inspections, make sure it's not upside down. And anyway, you've got to plan for that.
Well, you might have to account for some tenant improvements too, right? I mean, you might have some leases running out where people are either renewing a lease, but they want some TI with that, or maybe someone's moving out and you've got a new tenant that's going to want some TI, and so that's not included. Is that right?
Very, very good point on retail, especially because one thing we do when we're evaluating retail is we're looking at the rent roll and seeing whose lease is coming due in the next 1, 2, 3 years, because that's going to mean expenses, capital expenses in our mind, both to renew that tenant, or if they move out, to cover that rent and to provide a tenant improvement for a new tenant. And that can really hurt your cash flow and therefore your return. So.
Yeah, and that's in almost every asset class. Retail, single tenant, quick service retail, industrial can be a really expensive one with tenant improvements because they're so specialized. You can get into the weeds on that quite a bit. But yeah, there's not only tenant improvements, but leasing commissions. I don't know if we touched on that. You're going to have to pay somebody to potentially backfill the space if they leave. So
yeah, those are typically not in the cap rate evaluation.
They're not in the cap rate. So you can't just go out and say, hey, there's this 10 cap deal, it makes $100,000 and you're just planning on distributing, whatever you don't pay in debt to your investors. There's other things that you have to underwrite that go back into the property. Their reserves, their leasing commissions, their tenant improvement dollars. And you can't just save all the money. At some point you got to reinvest back in. You know what I mean?
Mm-hmm. So the next one, Brian, the next one has to do with market growth. So why is someone willing to buy 5 cap deals in, let's say, hot markets? What would be the advantage to them doing that?
Well, you've got rent growth, right? So you've got a hot market, and so the rent growth that could happen in those markets can go up quite a bit. 3, 4, 5% a year, maybe, depending on how hot it is, and so that's going to improve your property value quite a bit.
Absolutely.
So you're saying that you may get more rent growth on a property that has a lower cap rate. The property has a lower cap rate because it's probably in a better market, right, a better location, a better asset. And, a better market may be Austin. Austin is getting a ton of new people.
Yeah.
People are moving into Austin in hordes. They can't build houses fast enough. They can't build apartment complexes fast enough. Jobs and companies are moving into that company. So you're getting massive amounts of job growth. There's new jobs created in Austin all the time, all the time. There's new apartments created there. So you can go into that market and you can say, hey, it's a 5 cap. It's skinny. We may not make money for the first couple years. We may end up in a negative leverage situation depending on your interest only or how you get the loan and everything. But we know that we can get way more rent growth in Austin than we can another market. Let's say, St. Louis or Tulsa or something like that.
Yeah, the demand for, in multifamily, the demand for space for people to live, that's going to go up. The retail, because there's so many people in that are needing to buy things and go shopping and go to restaurants and that sort of thing, because of the high growth in that area, then those property values are going to go up too.
Yeah, so, going back to you, Joel, why are these investors, why would they rather go buy a 5 cap in Austin than a 10 cap apartment deal or an 8 cap apartment deal or a 7 cap apartment deal in Tulsa or another market?
Just like what we were talking about, they are looking at it from a standpoint of, yes, the the day-to-day cash flow is going to start low, or maybe even be non-existent, or maybe their cash on cash is 5%, pretty low. But that rent growth grows that faster. But the compounding of that additional income growth compounded at a 5 cap in that market is going to supersize their sale price. And so not only is there less risk, but they have a higher potential for the back end with that rent growth. So that's why someone would do that. Now, you're kind of betting that the situation remains, that rent growth is there year after year. But all of real estate is risks on some form or another. If you're buying an 8 cap deal in a market that doesn't have rent growth, that doesn't have job growth, population moving in, the cash on cash day one is going to be better. And so maybe that's a secure position for you then, but you may be missing out on the back end upside depending on that cash on cash. So the total return you may make may be less than that 5 cap in Austin. It just depends on the circumstances.
Yeah, and I think that's a good segue to the next point is talking about the exit. You know what I mean? When you go in and you increase a 10 cap deal or, an 8 cap deal, if you're going to go buy an apartment complex in Tulsa, you're probably going to buy it on, a 7 cap around there, let's just say, right? So increasing that income, you're going to sell that income for a 7 cap. Whereas if you increase that income in Austin on a 5 cap deal, then that income that you're increasing is worth more. Mm-hmm. It's just worth more. Right. So that may be another reason people are going to those markets is because, you can measure the rent growth better, but at the same time it's just worth more in the back end, like you said.
And so to put it, cap rates do not take into account sale prices. So that's a negative for a cap rate, is that you're getting a day one picture on yearly NOI. That's it. So on the sale price, all of these factors will impact the sales price, but on the one we're talking about, rent growth, that's maximizing sales price, but also the market can change. So let's say you get into a market that's emerging and the cap rates are 7 today. 5 years from now, things in that market are selling at a 6 cap or a 5.5 cap. You've won that game because you're going to make huge returns. Where if you're going into a declining market, you may buy at a 7 and you may have to sell it at 8.5. Well,
that's
the cap
a really
rate
good point.
didn't let you know that where the future of that particular market was going, and so you maybe anticipated making a certain return. But if you have to exit at an 8.5 versus a 7 that you bought, you're gonna get hurt. Now, what you hope is that rents did improve somewhat over that time, and you waited long enough where inflation helped you, and you didn't lose money. You just didn't make any money because you're paying down that debt. So maybe you can get out of it, but it wasn't as good of an investment.
Yeah. Yeah, I think that was a great point because of cap rates. Yeah, I don't remember 100% where I was going with that because I was trying to listen.
That's okay. I got the next one, and I think maybe the last one we're going to talk about is cap rates don't measure where the rents are per market for the deal that you're buying. So all it says is day one, this is the NOI. But what if I have an apartment complex that hasn't been updated in 20 years and the rents are $200 below market? Yeah. There's a big chance that I can go in, and we've done this in our North Carolina facility, in our Indianapolis, and we've done it here in Tulsa, where they were lower, and we go and we fix the exterior up and we redo the interiors, and now we're getting $200 pops. And that really, really inflates the NOI. And the cap rate doesn't tell me that at all. So that's another good one to remember, is being able to increase those rents to market.
Well, can you do that on retail too? I mean, maybe not to the extent because you can't raise the rents percentage-wise as high as you can maybe on multifamily if you really fix things up. But you could do that on retail too, right?
Theoretically, you can do it on any asset class.
Yeah. Retail is not as dynamic as multifamily because multifamily you just have people moving in and out every month. Mm-hmm. Yeah. But I'll give you an example on our we have a local deal here in Tulsa Village South. We bought that at a really low per square foot price because the rents were really low. They were carried forward from the recession. The owner got hurt, and so he was just trying to fill stuff, and he put people in at $10 a foot. Well, in this area, rents should be $15 to $20 a foot. And so that's 50 to 100% increase. the thing is, I can't just go in and do that arbitrarily year one because these are long leases. They may be a 5-year lease. But as they've rolled, we've taken tenants from $10 to $14, $15, $16, and it's blown the returns through the roof on that deal.
So when you're underwriting that, it gives you more confidence to buy at a lower cap rate. Because you're assuming, hey, these rents are so under market, I can grow them. The cap rate's not going to tell you that, but it will give you the confidence to say, man, I know I can make this thing crank out a lot more money. I can buy it at a stronger cap rate because it's kind of irrelevant now, because this property's potential, let's say, is to make $1 million a year, and it's only making $500,000 a year now. I can buy that on a 7 cap because I know even if I sell it in an 8 cap and double the revenue, I'm killing it.
Yeah, that's a good point. So those are all, there's a lot of nuances in evaluating the returns in real estate. And like we talked about, the returns are increasing rents, the returns are paying down debt, the returns are an increased sales price, market caps moving in a different market. And the initial cap rate is just the starting point. And any discussion on potential returns needs to involve all of these factors. And for each one of these factors, unfortunately, there's assumptions.
Yeah.
And so real estate is just one big risk based on your experience and knowledge. I'm going to bet that I can increase these rents 3% a year. I'm going to bet that the exit cap on this deal in this market 5 years from now is going to be this. I bet I can get this interest rate on this deal. And so all of that's factoring in. But now we're going to tell you about what we use and what most people use to fully evaluate all of these returns. And it's the IRR, the internal rate of return. And it's kind of a complicated formula to get to a net present value of a streams of income. But in essence, you can think about it as it's the given when I get the money, yearly cash flow, potential sale price, CapEx expenditures put in, the flow of those and the timing of those all average to give you an average yearly compounding return. That's what the IRR is. And it helps take into account all of those different cash flows.
I just know IRRs can be a difficult subject, right? So just if you've got a different opinion on IRR, a different way we should maybe say it, feel free to leave it in the comments once.
Oh, yeah. But we're going to do a show. We'll do a show on IRR, and we'll kind of have a sample property, and we'll show you kind of all those assumptions that you put in to get to what your projected compounded yearly return is, the IRR. Right now, I would say on a multifamily deal, they're typically trying to hit mid-teens. Mm-hmm. In the past, we've hit some higher ones just because there was some rehab plays in the market. Our retail deals are typically upper teens to low 20s, just because they can be bought at a slightly higher cap rate.
Yeah, and one other thing I wanted to come back to real quick when I blanked earlier is cap rate compression, right? So your investors are going to ask this, and it's really important that you can't get all of your money, all of your profit. The entire business plan is predicated on buying something at an 8 cap, and then in 5 years, we're going to sell that same income for a 6 cap. You can't do that. Your investors are going to catch it. The people you're pitching the deal to, it's one of the most common questions we get all the time is what cap rate are you buying at and what cap rate are you ending at? Because you can just fluff all the return by putting in some ridiculous exit cap rate of, the market's going to go nuts. This is going to be the most desirable asset class in the world, and I'm going to sell this on a 5 cap. It's like, well, the asset isn't producing any cash flow along the way. I don't want to just hitch a ride based on your hunch.
Yeah.
I would say, I've invested in some online syndicators, and so I have a little experience with looking at how they do things. The things to look out for online syndicators and even us, it keep us honest, is the two things. One is you mentioned what exit cap are they putting in, because that can determine kind of the final return numbers for you. But almost more importantly is the annual rent growth. What are they? Is it believable annual rent growth? Because that's going to drive your IRR more than pretty much anything else. Mm-hmm. And if they get too anxious there, then you won't find out for 10 years that they made the wrong assumption.
Yeah, right.
You'll get in the investment thinking this is a 25% IRR deal, but they're never going to get there because they just put in too aggressive of rent growth, and that could cost you. So
and the second, there's two things in IRR like you explained. It's money and time, and time is equally as important as money, right? Because if you make $1 million and it took you 40 years, but if I made $1 million and it took me a year, there's a percentage there, right? I mean, time is an equal component in that.
Yeah.
Well, cap rates can hide a lot of crazy crap. You can't just believe them. It's basic profitability. You got to dig in. You got to know what questions to ask. You got to know where to look, where the money might be going. That's not on a cap rate. You got to know how to increase the money. You got to know how to underwrite cap rates in the beginning and in the end. But cap rate is a great tool still, even with all of these problems. You just got to know, hey, before I go on this cap rate, I've got to double check my list, so to speak, and make sure I'm not going to fall in one of these hidden traps. But if you do it, it's going to help. It's going to save you some problems. It's saved us. I think that's it.
All right. Thanks, guys.
Thanks.